Imagine waking up one morning. You open your banking app and everything's frozen. Not hacked. Not missing. Just unreachable. Your bills are due. Your paycheck is processing. The screen says, "Please wait." In a world of fast payments, digital wallets, and collapsing regional banks, you have to wonder, is your money really safe in 2025? Today, we're diving deep into the uncomfortable truths about banking, what's happening behind the scenes, and what you can do to protect yourself before it's too late. 20 years ago, banking was simple. You had a brick building, a banker who knew your name, and your money sat safely in a vault. But 2025? It's a digital battlefield. Online-only banks dominate. Fintech companies like PayPal, Cash App, and Venmo are offering bank-like services. Artificial intelligence manages risk, loans, and even customer service. Branches are disappearing fast. Sounds efficient, right? Here's the problem. The more digital things get, the more vulnerable they become. Cyber attacks, system failures, server outages, these aren't rare anymore. They're a regular part of our financial lives. And most banks? They're struggling to keep up with the pace of technology while managing the old risks, bad loans, collapsing real estate sectors, and economic instability. Let's be clear. The biggest threat to your money isn't just hackers. It's a combination of several hidden risks most people never think about. 1. Bank failures are more common in the last 24 months. We've seen over a dozen regional bank collapses. Rising interest rates have crushed banks that overinvested in low-interest bonds. Many banks are still sitting on unrealized losses, just waiting for the next crisis. 2. Bail-in policies. Did you know? In some countries, banks are legally allowed to bail in by using your deposits to stabilize themselves in a crisis. While the U.S. has FDIC insurance up to $250,000, that safety net only stretches so far during a systemic crisis. 3. Digital outages. Major banks have suffered app crashes and network failures during peak periods, leaving millions temporarily cut off from their funds. 4. Inflation erosion. Even if your money is safe in a bank, it's losing purchasing power fast. 2% inflation? Try 5%. Your savings aren't just sitting, they're shrinking. 5. Increased surveillance. Banks now track and flag unusual activity at unprecedented levels. Government regulations have expanded. Privacy? It's not what it used to be. You might be thinking, but I'm insured by the FDIC. True, but let's break that down. FDIC insures up to $250,000 per depositor, per bank. But the insurance fund is tiny compared to total deposits in the system. If a few banks fail, fine. If dozens fail simultaneously, there isn't enough money. In fact, during the 2008 financial crisis, the government had to step in outside FDIC processes to prevent a complete meltdown. FDIC is a safety net, not a guarantee. If a worst-case scenario unfolds, you could wait weeks, months, even years to fully access your insured funds. You might assume your money is safer in big banks like Chase, Wells Fargo, or Bank of America. And honestly, it is. To a degree. Big banks have higher regulatory scrutiny, more diversified assets, emergency lending access to the Federal Reserve. But here's the brutal reality. Big banks are also bigger targets. Cyber attacks focus on the largest players. Public trust can vanish overnight if confidence is lost. Even big banks are interconnected to risky sectors like commercial real estate, tech startups, and volatile markets. In a true global financial crisis, size won't equal immunity. It will simply mean a bigger mess. Okay, enough doom and gloom. Let's talk solutions. 1. Diversify your banking. Don't keep all your money at one bank. Use multiple institutions. Consider a mix of big banks and strong local credit unions. 2. Stay below FDIC limits. Keep individual account balances under $250,000 wherever possible. Joint accounts are separately insured. Use the FDIC's calculator tool to maximize coverage. 3. Hold some cash. Keep a few weeks' worth of expenses at home securely. In a digital outage, paper money still works. 4. Watch Bank Health. Check your bank's financial health ratings. Sites like Bankrate and Bauer Financial grade banks based on safety metrics. 5. Consider Treasury bills. Short-term U.S. Treasury bonds are one of the safest places to park money outside banks. They're backed by the U.S. government and currently offer attractive yields. 6. Learn self-custody skills. If you invest in assets like crypto, precious metals, or alternative currencies, learn how to self-custody them properly. Relying on third parties equals new risks. 7. Build emergency funds. Ideally 3 to 6 months worth of essential expenses. Not just for job loss, for system disruptions too. The 2030s will look very different. Here are some trends already taking shape. Central bank digital currencies. Governments are exploring fully digital money issued directly by central banks. Programmable money. Funds that can be programmed to only be used for certain types of purchases. Biometric banking. Face ID, retina scans, voice recognition for daily transactions. Reduced cash. Physical cash will continue to decline in everyday use. Greater consolidation. Smaller banks will merge, leaving only megabanks and digital-first fintech platforms. Some of these innovations bring speed and convenience. Others raise serious concerns about control, privacy, and freedom. So, is your money safe in 2025? The answer is complicated. Your money is relatively safe today if you're smart, prepared, and diversified. But the bigger truth is, safety isn't something you can outsource anymore. You have to take an active role in protecting your financial future. Stay aware. Stay flexible. Stay resilient. Because, in the world of banking, fortune will favor the informed. If you found this breakdown helpful, don't forget to like this video, subscribe to Money Blueprint, and share it with someone who needs to hear this. Financial knowledge isn't just power, it's protection. I'll see you in the next one.